Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. This is the weekend edition where we interview notable people from the world of real estate investing. Today's no exception. We have a great guest all the way from Philadelphia, Pennsylvania. And welcome to the show, Ed Rogan.
Thank you. Thank you for having me.
Great to have you here. So, Ed, we both work in the Philadelphia market. We've done an awful lot of infill development in the market. And what I thought would make sense for us to focus on, because Philly, like many cities all over America, has those fringe neighborhoods, those areas where you go a few blocks too far, you're in the hood. And this is an area where you've been specializing for a number of years. So why don't you give us a little bit of your backstory and how you got into this particular specialty?
Sure. Penn Capital, we started back in 2017. And we actually didn't get our first deal done until 2018, but we were focusing on markets in the South and Southeast, mainly for garden style type of apartments. So my partner and I, we had done some single family projects individually before we started Penn Capital, and found that, our friends and family and people wanted to get involved. So we decided to come together and build a platform so that investors could, invest in the deals passively with us, which opened up the opportunity to get into larger scale projects. And to get started, especially, where we were at in 2017, the market was hot. There was a lot of players, that already had been doing these types of deals that we wanted to do. So it was difficult for us to get involved and get our offers accepted. So we decided to kind of pivot our strategy a little bit from the stabilized value add type of acquisition and look at more of the redevelopment level acquisition. So projects that were distressed, whether that be management distress or fund level distress or debt distress, maturity risk. So we found that there was more opportunities available to us, especially in garden style apartments that were suburbs rather than infill redevelopment. And we selected a handful of markets based on job growth and some other demographic factors, and found our first deal, which was in Alvin, Texas, which was slightly outside of Houston. That neighborhood was interesting for us because a lot of people were afraid if there's another market level below tertiary, I think Alvin would fall into that level because it's part of the Houston MSA, but it's about 10 miles from Houston's outer loop. So it's kind of a rural / suburban neighborhood. However, there were about 5 or 10 existing apartment complexes, and they haven't built anything in the previous 10 years. So the demand there was solid. All the properties there were operating at 90+% occupancy. And what we found that the fact that there was so much going on in Houston, so much new construction, but a lot of the new communities that were developing and growing were in South Houston. For example, Pearland, which was about 5 to 7 miles from Alvin. And then also you had League City to the east of us, Texas City, and some of the other more affluent suburban markets that were in Southeast Houston. So we figured, with the pricing increasing there, plus at the time, a lot of the downstream oil and gas economics were starting to really pick up. So Dow had built a big chemical production facility, and there was a lot of oil refineries there in Southeast. So we decided that being in Brazoria County, that's where our play would be. The demand was already solid in Alvin, but we thought at the time it was going to pick up and grow as more people were priced out of Pearland and League City. So we ended up being correct on our assumptions there because we've been lucky to maintain 93, 94% occupancy with the ability to raise rents, probably about $125 overall on renovated units. So from there, we thought this is a great opportunity, especially when there's a lot of competition for deals at premium prices in the major metros and in the hot neighborhoods, to find some of these sort of fringe markets that aren't necessarily, or I won't even call it market, but neighborhood, that aren't necessarily popping out as highly attractive until you dig into them and find out how some of the economic is growing around you, how some of the demographics are growing. within a couple mile radius, and decided that that would be our strategies to where we can still get in and buy deals at a fairly discounted price and still have the opportunity to add value.
So fringe neighborhoods often mean different things to different people. Sometimes that's a euphemism for meaning it's a high crime area. For some, it means people are broke and they have no money. What does that term mean for you? And what risks does investing in a fringe neighborhood bring?
So to your first point, definitely, high crime areas, but I'll get to that. I look at that in two ways. Also, just, a neighborhood that if it's within the major metro, if it's within where everything's going on, and it's not kind of out on the outskirts, then it would fall into that fringe neighborhood. Whereas it's kind of an area where there's been either economic problems or it's had high crime issues and, just kind of blight situations. We look at those areas again as if it's also on the outskirts in the suburb. So we definitely don't go into those neighborhoods if we don't see actual progress that we believe is going to be running through there. So if it's, within the path of progress, that's when we start to get interested in it. And we try to pick up on those types of trends early while the prices are still relatively lower.
I love that. Well, certainly the southeast of Houston is one area that we've paid a lot of attention to, and we don't have anything in that market right now. We're actually developing in the northwest, but we've taken a look at properties in the southeast of Houston, and I agree with your assessment that there is opportunity there. There's strong employment, very strong employment, in fact, but the price points aren't very high. We've often found that there was, like you said, not a lot of new product. I mean, think about communities like Beaumont. Not a lot of new products been built in Beaumont in many, many years, yet they're almost full occupancy.
Yep. And I think those kinds of neighborhoods like Beaumont, there's a very solid, working class demographic there because you have so much blue collar manufacturing plants, chemical manufacturing, oil refineries, gas refineries. And also they had some not automobile, but other manufacturing plants. So it's a great working class neighborhood. So if you're looking at Class C, Class B type properties, there's tons of demand in those kinds of markets because it's not really feasible to build brand new Class A ground up development there. With those areas growing in population and households, you can get in at a reasonable price and still realize value add upside from the in-place economic chain of work that's around there, the employment centers. And a lot of times, we find that, especially in Houston right now, if you look at Houston right now with the oil and gas issue happening with the industry on a down cycle, in West Houston, over by West Chase, is where a lot of the Class A type of demographics reside. And you have a lot of oil and gas headquarters and white collar types of job center there. Now, they're getting hit pretty hard over there because with the loss in jobs that were tied to those, oil and gas headquarters and executive offices, we're not seeing that in some of the more blue collar working class neighborhoods. We're actually seeing, if anything, growth in demand. So the reason why we like working class is because the supply is restricted. It's hard to build new working class housing unless it's considered affordable housing. And so if you get into a market that's solid, where the people are working and jobs are growing, then you can really do well.
Well, jobs are the key because I know there's been an awful lot written about the 6,000 small independent oil and gas companies, significant fraction of which at today's oil prices are expected to go insolvent. What that means is that a whole pile of debt's going to get written off and a bunch of companies are going to go bankrupt, but the oil is still going to be there. The ownership of those wells are going to change hands, and those wells are still going to remain in production. So those people are still going to remain employed. They may have a new employer. It might be a bank that owns them. They might become employees of the bank, but those oil wells are still going to be producing.
That's why we like the downstream centers too, because if anything, when the price of oil is cheap, right now the problem with the downstream is that there's not enough places to store all the product. They're having to store it offshore. But as far as the refineries and the chemical manufacturing plants, they're buying as much as they possibly can right now while the prices are low and the futures are low. So they're, if anything, having to increase production and increase their employment count in order to increase their production levels to continue buying cheaper product. So that, that's why we're not really seeing too much of a hit on the downstream side, which is where a lot of the blue collar workers are, which is a lot of southeast Texas, or Houston, even into Lake Charles, Louisiana, is another strong market that's over by Houston there.
Yeah, and we're actually very heavily invested in Lake Charles, Louisiana. We have a number of projects in that community, and we like it for the growth that it represents.
Another place where we do have assets is in a city called Huntsville, Alabama.
Okay.
Which I don't know if you're familiar with Huntsville, but it's kind of a tertiary market in northern Alabama, and it is just south of Nashville. Actually, it's just over the northern border of Alabama.
Actually, very familiar with Huntsville. You've got now a couple of fairly big Japanese auto manufacturers that have come into town, so it's pretty strong employment growth. What I've noticed about Huntsville is, it's a good workforce. It's a fairly educated workforce. It used to be R&D centers for both military and radio in years past. But what I'm seeing in Huntsville is that the dollar per square foot, the rental rates are still fairly low. They're around that $1.10 a square foot. And even though there hasn't been much new construction and, in fact, very low vacancy, it hasn't pushed rental prices up, which is one of the things you often expect to see in a market when it gets capacity constrained. You start to see new product coming into the market and you start to see prices coming up. And we haven't seen that in Huntsville.
Yeah, that's you're 100% correct on that. We've dug in and done a ton of research on that market, and we found out that the reason why prices have been restrained there's a couple of factors. The Huntsville market has opportunity there because what you're going to start seeing now is those prices start to rise, because what we found going into Huntsville was there's very limited supply. There's a growing demographic and there's growing job center. However, I would say out of all the markets, we've looked at and have done in-depth research, including Houston, there are a lot of mom and pop owners there. There's probably 4 or 5 owners that have owned in Houston for the past 20 years plus and have held those properties. And they probably own about 20% of the market share of garden style Class B and C properties. And they have very little debt service, if any, a lot of these owners. And what happened is they have not really pushed rents and have not done anything besides deferred maintenance in a lot of those assets. So without having any debt service and with with maintaining an occupancy above 90%, they haven't really had much of an incentive to go in and push rents. So when they bought their property 20 years ago, who knows? It's probably, they probably paid 10 cents on the dollar compared to what it would be worth today. But now that new outside buyers are coming into the market, starting to do the renovation turns, they're starting to see, the rents pick up. So I would say probably in about another year from now, you'll start to see that rent growth. But the market overall has about a $75,000, median household income. Yet you're right, the average market rent is down around $750, maybe $800. So their rent to income ratio is like 15%. It's really incredible. Whereas the rest of the country right now is teetering on, 30 plus. So there's a lot of room for growth there. Places like Dallas, you can't get into anything right now, less than $80,000 a door if it's stabilized. And the problem there is wages aren't growing fast enough to keep up with the rent growth. Because when you buy a Class C property that was built in 1975, for $100,000 a unit, you have to maintain, at least a 3-4% annual rent growth, if that, maybe even more, to be able to pay your debt service and at least keep a 5% cash on cash distribution rate. In a market like Huntsville, where you have the research and develop, second largest R&D center in the world, or in the country, fourth in the world. You have 4,000 jobs coming in for the new Toyota factory. And then there's another 4,000 jobs coming in for the FBI headquarters that they're building. So it's only a matter of time until that demand pressure starts to put enough upward pressure on rents that we'll start seeing that growth. But yeah, I think it's about a good year and a half maybe away till it really starts to show.
I love it. Well, Ed, if folks want to learn a little bit more, if they want to get in touch, what's the best way?
They can look us up on our website, penncapitalgroup.com. Our contact info is there, or they can reach out to me directly. My email is ed.rogan@penncapitalgroup.com, and that's Penn with 2 N's.
Terrific. Well, Ed, thanks for sharing the perspective on 2 very interesting markets, certainly the southeast of Houston and Huntsville, Alabama. And for the listeners at home, definitely reach out to Ed at Penn Capital. Is it Penn Capital Group?
Group, yep.
Yeah. At penncapitalgroup.com. That's PENN capitalgroup.com. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.